Hi guys, I'm Manu and welcome to another episode of Sweet Money. Today we're going to talk about what you can do starting today to help you prepare for the 2024 tax season. The purpose of this video is to help you maximize the refund you get from the government. Therefore, grab a piece of paper, grab a pen, you'll be taking some notes. I'll see you guys on the other side. Now, in order for you to get the full benefit of this video, it is important you watch till the very end because each tip can put money back into your pocket. All right. And I don't want you to miss out on anything. The ideal time to work on your tax strategy is during the summer months. It gives you time to strategize, save, and budget. However, if you haven't done so, it's okay. We can still make things work in your favor. One last thing before we get started. I know you guys are getting very anxious, but just bear with me 1 more minute. Your mom always told you to eat your veggies. Your advisor, your tax advisor, is telling you to see your accountant at least once outside of tax season. If you are not seeing your tax accountant and you fall into one of these 3 categories, book a meeting with me on my website and I will set up a free consultation with you. Those 3 categories are: number 1, you have a family business. Number 2, you have equity north of $1 million. Number 3, you have complexities in your tax return. If you fall into any of these categories, please reach out. Number 1, donations. I've written a blog on my website. Please check it out. It's pretty detailed. But for today's purpose, what I want you to know is you can donate as much as you want. There's no limit. However, you only get a tax credit on up to 75% of your income. Therefore, if you earn $100, you can donate up to $75 for which you will receive a credit. Anything above and beyond that, your accountant will then defer it or carry it forward to future years. Now, the way your tax credit works is the first $200 that you donate, you get a 15% tax credit. Any amount above and beyond $200, you get a tax credit of 29%. And depending on where you live, you might be entitled to provincial credits. Yes, you can donate tangible and intangible assets in lieu of cash. For example, you can donate your car. That's a tangible asset. An intangible asset would be, for instance, if you owned the catalog to an artist, a music artist, and you had the rights to their songs. But please make sure you keep those donation slips. I know from experience, if you lose a donation slip, good luck trying to get another one from that charity. Before we move on, I want to talk about political charities as well. On the first $400 that you donate, you get a 75% credit, which is equal to $300. Any donation between $4 and $750 is 50% for a credit of $175, and between $750 and $1275, it's 33.3 for a credit of $175. The maximum credit you can get is $650. Moving along, medical expenses. Eligible medical expenses in excess of the lesser of $2,759 or 3% of gross income can be claimed as a federal tax credit. Therefore, the strategy behind this is if you need any medical equipment next year, because what you have right now needs to be replaced, it might be worthwhile to purchase that equipment today so that you maximize your credit. Because what you don't want happening is that when you split your expenses between 2 years, you might not be eligible for that credit. So it might be better to put all your expenses into 1 year as opposed to dividing them. Hopefully that makes sense. Union and professional membership dues. It's amazing how many people are not even aware that these expenses are tax deductible. So if you belong to a union, or if you're an engineer, or if you're a lawyer, or you belong to some other professional association, whatever membership fees you pay out of your pocket is tax deductible. And your accountant might not ask you about this. Therefore, you please make sure you give them the slips during tax season. In addition, if you believe that you belong to an accredited professional association or an accredited union, but you're not entirely sure, just ask your accountant and they will advise you accordingly. Investment counsel fees, interest expense, investment expenses. Yes, if you're taking a loan to invest in the stock market or in a business, all the expenses that you incur in order to acquire that loan is tax deductible. In addition, the interest that you pay on this loan, which is helping you generate income, is also tax deductible. And once again, if you're not sure whether or not an expense is tax deductible, ask your accountant. But if you're not even aware that this might be tax deductible, you won't even ask. And that's where people lose out on potential refunds. Deductible legal and professional fees. Now, this is slightly different. If you are going to acquire a business or if you're going to form a partnership with someone, in that instance, all expenses incurred in acquiring the business or forming a partnership, those expenses can also be deducted. Now, this gets a little complicated. Certain expenses are capitalized. What that means is these expenses get added to your acquisition cost, your ACB, adjusted cost base, and it's amortized over the duration or the life of the business. And in certain cases, the expense is 100% deduction in the first year. It is very important. Once again, I sound like a broken record. Speak to your accountant, keep all your receipts, and make sure everything is properly detailed so you don't miss out on potential refund opportunities. And guys, give me some SLC. SLC stands for subscribe, like, and comment. Now, this one might surprise a lot of you. The interest that you pay on a federal or provincial student loan is tax deductible. The title says it all. I don't think I need to say anything else, but here's 2 sentences on it. A lot of people are not even aware of this deduction. Non-CPAs filing your taxes are not aware of this deduction. I know a lot of people, especially coming out of school, who aren't making a lot of money on their junior salaries, like to save money by cutting corners here and there. But when it comes to your tax accountant, if you cut corners, you might do more harm to yourself than benefit. So spending a little bit more money might drastically increase that tax refund or drastically decrease that tax liability. RRSP contributions. This is the Grand Slam. This is the Super Bowl touchdown. This is the Game 7 overtime goal. You can contribute up until the age of 71, and then at the age of 71, you have to wind up your RRSP. And when you wind up your RRSP, please speak with your accountant and please speak with your financial planner. I'm sure you're seeing a trend by now of who you need to speak with. What you need to be aware of is for 2024, you can contribute into your RRSP the lesser of 18% of your gross income or $31,560. The lesser of those 2 numbers. Here are some extra points to consider for your 2024 tax year. Did you make TFSA contributions? Did you maximize your TFSA contributions? Did you, by mistake, unknowingly go over and beyond your TFSA contribution limit? Understand the difference between the TFSA and RRSP. Please watch my video on this. It's called RRSP and TFSA has been decoded. A lot of people ask, should I sell my investments in which I am seeing unrealized capital gains? And there's no easy answer to this because some of you have come to the conclusion my stock will never go back up to the price at which it was acquired. And it happens, it's life. But that decision, whether you sell it this year or next year or the year after, depends on multiple factors, such as what is your income? What is your tax liability? Do you have realized capital gains? In some instances, it might be worthwhile to cut your loss and reduce your tax liability. In some instances, it might be worthwhile to hold on to that loss because you don't want to trigger an alternative minimum tax, which is also known as your AMT. Now, in addition, CPAs are not allowed to give stock advice. What we are allowed to do is give you tax advice, is that given your situation, what is the best strategy for you? Another topic to discuss with your accountant is if you moved or relocated in 2024. Make a list of all your expenses. If you are not sure about an expense, add it onto your list. Have more than less. I'll tell you why. Because an accountant will get rid of what is not eligible. But if you start playing Mr. and Mrs. Accountant, then you might leave things off that list which might be eligible, and that will harm you. And we don't want that happening. And you might not like this, but if your employer gives you a moving allowance, that allowance will be counted as income. I don't make the rules, I just report them to you. In addition, moving expenses are only deductible if you moved for employment purposes, business purposes, or educational purposes. If your girlfriend kicked you out of the house, that does not qualify as eligible moving expenses. Sorry, guys. Choose wisely next time. In addition, guys, there's always a layer on top of the layer. The moving expense is only eligible if the new place to where you have relocated is 40 kilometers closer than the previous location. Trust. Trust is a big one. Last year, for the 2023, the Bear Trust created a lot of confusion. My boy JT passed a rule that Bear Trusts would be taxed. We had to prepare a T3 and a Schedule 15 and report it to the CRA. There was so much confusion, at the end of the day, they ended up scrapping the entire idea. For 2024, the good news is that you do not have to file or submit a T3 or a Schedule 15 if you own a Bear Trust. And for this, guys, we have to thank our CPAs, the industry groups, and our media for making this a possibility. Guys, hear me out on this one. The CRA loves to audit this specific topic, and no hanky-panky on this one. I'm telling you right now. If you have a company car, okay? Now, this is how it works. You have a company car, you drive it for business from 9 to 5. After 5 o'clock, you park it on your driveway, but guess what? You need groceries, your kids got to go to activities, your partner needs something, and everyone's using this car. You need to go somewhere as well for personal reasons. Now, any kilometer added to the odometer for personal reasons is taxable. You are receiving a benefit. Yes, I admit you're not getting paid, you're not getting any money. However, you are receiving a benefit. And according to the Tax Act, if you receive a benefit from your employer, it is taxable. So the percentage of the odometer, so the kilometers that you drive for personal reasons versus the kilometers you drive for business reasons, have to be separated, including the expenses associated to personal versus business have to be separated, and whatever is personal is taxable. So that made sense. If it didn't, speak to your accountant. Last one. Have you paid your tax installments, or do you require relief? Okay. This might sound silly, but it's very serious. If you know come April, you will have a liability, and if you know you will not be able to pay your taxes, speak to the CRA right now. Call them, explain to them what's happening in your personal life, write them a letter, submit this letter through the CRA portal in your account. What this will do is they will give you some breaks. They will show some leniency towards you. They might not charge you interest. They might not charge you a penalty. They might put you on an installment plan. If you stay quiet and just hope that the boogeyman doesn't catch you, you're asking for trouble. And in my video, a CRA audit is coming. Are you ready? You don't want to fall onto their radar. So do the right thing, do yourself a favor, and get ahead of the game. And remember, it all starts with a simple conversation.